I'm Robert Rain, Chairman of the company. Thank all of you. I'd like to thank you all who connected via the webcast. The time is just after 3 o'clock now, and the registrar has informed me that a quorum is present. I therefore declare the meeting open.
Robbie, sorry, can I just pause you? We should have Jamie. One of our directors is dialing in. He should be on screen so you can
Yeah,
see him.
he'll pop out.
Oh, will he?
At the
Okay.
moment, yeah.
Do my job properly. Okay. We have one director joining us on the screen. He will pop up in a second. I think I'll carry on in the meantime. I'm delighted to welcome at least some of you back in person to the AGM this year. As you would have seen, we're broadcasting proceedings over the internet, or we're about to, using the Investor Meet Company platform. I should point out that participants joining via this medium will legally be observers rather than participants of the meeting. We have received some questions from shareholders for consideration ahead of the meeting. The webcast also allows questions to be typed and submitted during the meeting. To the extent these are not covered today, we will answer following the meeting, any you have. Do please avail yourself of the facility if you would like to do so. We're very happy to discuss all areas of the company at this meeting, but equally are always very happy to respond to shareholders' questions in a one-to-one conversation. You're always welcome to email us or call us. I'll be happy to speak to you. Jamie Wilson has joined now the meeting. I'd like to introduce the board. So I'll start with Jamie, who's on the screen. Peter Harvey on my left here, Nick Fridos, who you know, and Graham Stephan on my right. I'm going to sit down. Nick Fridos is Managing Director, a member of the Investment Committee and the Nomination Committee. Peter Harvey is Non-Executive Director and Chairman of the Audit Committee and a member of the Nomination Committee, Remuneration Committee and Investment Committee. Graham Stephan, on my right, is a Non-Executive Director, Chairman of the Remuneration Committee, a member of the Audit, Nomination and Investment Committees. James Wilson, Non-Executive Director, Senior Independent Director and member of the Audit Committee, Nomination, Remuneration and Investment Committee. Myself, I'm Chairman, I'm non-executive, and Chairman of the Investment Committee and the Nomination Committee. I'd also like to introduce Alicia, who's over there, on behalf of IQEQ Corporate Services, our company secretary. Thank you. Review of the year. You will no doubt have seen our most recent quarterly NAV announced on the 28th of April. Our next scheduled NAV update will be on the 30th of June, half-year results due at the end of July. Before we start the formal business of the meeting, I'm going to ask Nick Fridos, our Managing Director, to provide a brief overview of how we're developing the company and positioning it, hopefully, for success. Thank you.
Thank you, Robert. Well, good afternoon, everybody. I'd like, in the next few minutes, to talk to you about how we, the board, think about delivering returns to you, our shareholders. So, as you know, LMS Capital is a small listed investment business. Was part of what was until 2006-07 London Merchant Securities, a real estate REIT with some investment assets. Your team demerged the non-real estate investment assets from the REIT, which it was then itself merged with Derwent Valley to create Derwent London. So as an independent entity, this company, LMS Capital, has returned over £200 million in cash to its shareholders over the last 15 or so years, a large part of that in the period 2012 to 2016. Today, we are a self-managed investment business. We have a strong balance sheet, which puts us in a good position to take advantage of opportunities in the market that we expect to present themselves. Our 31 NAV position, actually, sorry, Alicia, could you just roll on to the next slide? Our 31 March NAV position, which was most recently reported, showed gross assets of approximately 48 million, 2 million of liabilities and sundry liabilities to come off that, leaving 46. And that broadly breaks down 20 million in our mature assets portfolio, and I'll talk about each of these in a moment. 10 million pounds is in Dacian, our energy investment completed in November 2021, and was part of the first investment as part of the new post-2020 LMS investment strategy. And there's 17.5 million of cash still to be deployed in line with our new investment strategy, about which I will say more in a few minutes. We have no debt. So let me just talk a little bit about our approach to investing and really the context for our business. So our focus is to operate in areas where we believe we have clear competitive advantage. We want to generate returns that may not be accessible to others, either because they may not see them or may not have the capacity to execute them. In 2020, we outlined 3 themes for our investment activity: energy, real estate, and late-stage private equity. We are increasingly focused on the first 2 of these, energy and real estate, where we have competitive advantage. Our experience and knowledge of those sectors, our access to teams and the expertise that they bring, and our access to deal flow in those sectors, and our ability to execute on those deals. Excuse me. When we make the decision to invest, as well as satisfying ourselves that the underlying assets are going to give us an acceptable risk-adjusted return that's in line with our targets, or exceed our targets, we're looking for situations that are not just one-off, but they can be developed as operating platforms in which LMS has an ownership stake, which allows us to benefit not just from our investment return on the assets, but also from the operating cash flows of a business. So if we invest today with a team to acquire and operate assets in energy or real estate, we want to believe that we and they together have the capacity to attract additional external capital onto that platform to expand the asset base in which we've invested. This means that, as I say, as well as our underlying asset returns, we're actually creating an operating business, and LMS can share in the ongoing operating cash flows of that business, which are generated in addition to the assets that we've invested to get it going. Can you pop onto the next slide? In our December 2022 annual report, which you have in front of you, and was published a few weeks ago, we identified 3 priorities for 2023 to continue to manage our mature assets, to support the Dacian team in its 2nd year of operation, and to bring to fruition the work that we're doing with our real estate teams in developing opportunities to deploy new capital. Those are the 3 things that we're very focused on this year. And let me just talk to you a little bit about how we're going about each of those. So our mature assets, a portfolio of roughly 20 million pounds, and there are 4 or 5 significant positions in there that really make up the bulk of that portfolio. These investments are generally fund investments or co-investment positions that were originally invested in by LMS prior to 2012, and generally, with one exception, are managed by third-party investment managers. So we don't, in those cases, control the decision about when and if to realise the assets. But what we do is maintain an active dialogue with those managers. We know them very well. We share their thinking. We have an opportunity to talk to them and influence that thinking. And for us, that's very the timing of the achievement of the right exits on those assets is a very important component of our business. As I say, we don't totally control that timing, so the timing of those exits. So the exact timing is quite difficult to predict. We're not expecting significant realizations in 2023, but we would expect to see realizations start to flow from that portfolio in 2024 and 2025. So turning to, our second priority, Dacian. Dacian is our investment in the Romanian oil and gas producer, which has acquired a portfolio of late life production assets in Romania. This was a $20 million deal, of which 14 was comprises subordinated loan notes and equity from a consortium which was led by LMS, and LMS is quite a big participator in that consortium, but we brought other capital alongside us. And then there is additional 6 million of external third-party senior debt in that structure. Dacian is a very good example of a situation which we like to invest in. So our access to the team was critical here, and their access to the asset. Without them, we could not have begun to think about making this investment. It's complex and management intensive. That's reflected in the acquisition pricing that we were able to secure and will ultimately drive return. It's a reflection of the specialist knowledge and capabilities of our team that they're able to take this on. We are also alongside the team in at the ground floor, which means we can use Dacian, and our ambition is to use Dacian as a platform to acquire more assets in the sector. The investment was originally underwritten in August 2020, but due to regulatory delays in Romania, only completed after an extended period in November 2021. So really 2022 was its first proper year of operation. And the focus in that time was really on bedding the assets down, getting to know them thoroughly, and really onboarding the 180 or 200 employees that transferred across to Dacian with that business. By the end of 2022, production was stabilized at around about 1,000 barrels of oil, or barrels of oil equivalent per day, because you've got both oil and gas being produced. But if you convert the gas to its oil equivalent, you end up with just around about 1,000 barrels a day equivalent. And that translated into revenues of about $32 million. The business was both profitable and cash generative in the year, after having invested, after having invested $3 or $4 million in inventory and certain other fixed assets and so on that they found they needed to start operations. The business continues to be cash generative. It's de-gearing and expects to have repaid fully the external senior debt for $6 million plus interest by the end of 2024. So that is performing entirely in line with our expectations. The investment case for Dacian was always based on a business plan of significantly expanding production from that 1,000 barrels a day through workovers to tap into additional reserves, and also in the conversion of some of the gas that's produced to power. The conversion of gas into electricity at the wellhead using specialist equipment is actually a very economically advantageous way to sell your gas into the energy network. The budget for 2023 for Dacian is to increase its production by around 20% or thereabouts from that 1,000 barrels a day. And if that can be achieved, it will show a very healthy EBITDA and cash generation. So our priority is really to support the team as they get into that first year's proper expansion of the business. The other area we think about is deployment of new capital, and particularly in real estate. We're deeply rooted in real estate and have access to outstanding teams and expertise in both the development and investment side of the real estate industry. So as we've reported and talked about a little bit in the annual report, and indeed last year's half-year report, we've been building knowledge and capability in the retirement living sector. with our development team. Our interest in this sector is driven by, I think, our belief that fundamentally the market dynamics are very favourable. There is undersupply and increasing demand. We believe that it offers prospects for attractive growth and attractive returns in the medium to long term. We're looking at potential targets to enter the sector. We have a number of things we're looking at. We are not committed to any at the moment, and they do take time to come through, but it's a sector we're looking at very, very carefully and built up quite a lot of expertise to do so. On the investment side, we also see opportunities in the current market and what may lay ahead. As with our energy investments, we're looking here not just passively to invest, but to get in on the ground floor, create a business which over time can bring more capital, to which can attract more capital over time from other people, and can create for LMS an influential and economically attractive position in a much larger business. So in summary, we have a strong balance sheet and we're positioned to take advantage of opportunities. I think the pace of deployment of capital since 2020 reflects some of the macro events that have affected us all. But we also acknowledge that our path is not necessarily quick to execute. Doing deals can be quick, but deploying capital to create long-term businesses which survive the vagaries of economic cycles and economic uncertainty is a different matter and can take longer. So we've remained disciplined in our deployment, and we believe our approach is the right one for this company and its shareholders. And we look forward to reporting progress to you as we move through 23 and beyond.
Please, any questions, now is a good time to ask them. We have received some questions ahead of the meeting, and to the extent they're not answered, we'll answer those
too. Could you or Nick explain in a little bit more detail what you mean by retirement living space? Are you going to be like a McCarthy and Stone, acquiring the blocks of flats which are then let out to the elderly with their own front doors, or more of a nursing home type arrangement?
Okay, yeah, very happy to do that. So, I mean, it's a complicated sector. There are a lot of different models, okay, but I think for the sake of this discussion, probably think about it in three categories. There are the McCarthy and Stones, which are really housing developments for certain aged people. At the other end of the spectrum, you've got care homes and nursing homes, which offer, you know, a lot of on-site, frankly, medical care and support. And then in the middle, what you've got emerging is our developments of various people described in different ways, but retirement living communities. And the idea there is that as a resident, you have your own front door, but it's part of a scheme, and there's maybe anywhere between 80 and 150 units on a scheme. It's part of a scheme where you have other facilities as well and infrastructure. So you've probably got a wellness suite. You've almost always got a bistro or a coffee shop or something like that. Frankly, depending slightly whether you're a city centre or whether you're remote. And you have entertainment rooms and those sorts of things. You have gardens that are maintained. And the important thing about it is, and you have 24/7 security and concierge and support. So if you're living, if you acquire a unit in one of those developments, what are you really buying? Obviously, you're buying a space to live. But on top of that, what you're buying actually into a sense of community, where you've got facilities that you can sort of participate in or not participate in as you choose, and you're really buying into a safe environment where there are people there. They're not medical people, but they're people there who will sort of look out for you, look after you, obviously keep the site secure. And be there to provide support that's required. The actual sort of medical care services that some residents may need and some may not need would then be provided by an outside provider. Actually, and different operators operate differently. Some operators provide those services well, but there's an additional cost to them. Other operators have relationships with good outside agencies that come in and deliver those services.
But that's the area that LMS is.
That is the area that we are looking at in
and
particular.
would the residents, what would they acquire? Would they acquire a leasehold interest in their front door? Or would they just have it on license?
They effectively acquire, well, there's both a rent and a buy model. So if you buy, what you're actually buying is depending slightly how they're set up, but think of it as sort of 125-year, a long lease with certain conditions and so on attaching to it. And as and when you pass that on to the next occupier, you will sell that. So it's a bit like a transaction in a freehold, really. It's not technically a freehold, it's a bit like a transaction.
So LMS would just have the freehold reversion to all the
LMS will have a freehold reversion in that sense. The other model is frankly just a rental model, where you're effectively there on something that's a bit like an assured short-hold tenancy. You may occupy for 5 years, 6 years, 7 years, whatever. The other aspect of it, which is a feature of this industry, is that when you buy your unit, you agree that at the time you sell it, a proportion of the sale proceeds revert back to the operator who's managed it, provided the infrastructure, so on and so forth during your period of occupation. So, as an operator, if you construct one of these developments, you will build it. Let's assume, example simply, you'll sell the units. You will receive a service charge, annual service charge from the residents during their period of occupation. And then when that unit is sold, you will, after however many years, 6, 7, 8, 9, 10 years, you will receive back a proportion of the sale proceeds as well, which really go to contributing towards your the cost of the central infrastructure and facilities and so on.
But the annual management charge would cover all of that.
The annual management charge really covers the cost of the people, the security, the cleaning, well, the cleaning of the common parts, the grounds maintenance, a minibus to the local town, whatever might be on the site. So that covers those, but it doesn't really cover the cost of constructing and maintaining the central amenities, the bistro, the reception areas, the other facilities.
And you'll be hoping to construct these from scratch, or would you buy existing units?
Well, both models actually. Constructing them from scratch is great, but it takes a very long time by the time you've found a site. And one of these we're looking at, we've probably looked at 50 sites in the last year, and we've probably got 2 or 3 that we think are actually viable. So constructing from scratch and building them out and getting planning consent and all those things is quite an attractive way to do it. If you can acquire an established site, which is, there's not many actually, there's not many established operations, there are a few, there's not many established operations for sale. Obviously, if you can acquire one of those, particularly where you're in our situation, starting from ground zero really, that gets you into the sector a bit more quickly.
And yes, we're looking.
I wish you well.
We're looking.
I might be a resident at some stage.
Should have
Yeah.
share
I mean,
with
it
this now.
is an interesting sector. It is evolving. There's quite a lot of capital going into it. There's quite a lot of capital, particularly going to high-end provision in London. What we have been doing is looking at mid-market, because you can debate what mid-market actually means, but it depends where you are in the country. But we've been looking at outside of London. We started out looking in the East and West Midlands, for example, and just looking at the demographics. There's lots and lots of data on where specifically you should go. It's like all these things, the micro location is actually quite important.
Good, thank you.
Are there any other questions?
What would you do? You get a builder, you drop a contract with the builder to build it if you're starting from scratch.
Yes, you would. You would acquire, well, basically, we would look at the site, decide with our team whether we think, is this a good place or not a good place to build one of these? How is it going to be set to sell? What are the local demographics in that particular town? We would get planning, but then, we wouldn't actually build it ourselves. We would then let a development contractor, somebody to build it for us.
They are to an extent specialist builds, because you know that things like bathrooms, kitchens, and heights of cupboards, all those factors are taken into account.
We want people to need certain things,
Yeah.
No other questions? Please.
Yes, the first question is about the mature portfolio, which, as you said, is about £20 million. I suppose it must be about 45% of assets. And it's quite a big chunk, really. It's the biggest piece of the jigsaw. And you said not much in the way of realizations in 2023, but more in 24 and 25. It's quite an important issue for shareholders what the profile of that is likely to look like. And in two ways, actually. One is capital growth, if any. And I would say, without going to specifics, capital growth on that's been fairly middling in the last year or two. Probably flat, if anything. And the cash is tied up. So in fact, the NPV arguably is going down, or could say the NPV is less than book value, depending on how you look at it. So I think there are two main bits that look as if they could give rise to something in the not too distant future. One being the Optus portfolio, there's two assets there, and then the other one being Medhouse, which is a big chunk in its own right. Are you able to give any more visibility on what you think might happen in terms of, even if you don't name names, just in terms of how the numbers might flow?
Well, we would obviously like to think, but we can't guarantee, that realisation you would do at least as well, potentially better, than we've got in the books out. That's what we would like to do. I mean, in terms of, in fact, in terms of Opus, Opus is a US early stage fund. It's quite an old vintage now. It's like 2008, 2009. It's one of these funds that had a large number of investments to begin with. The ones of those that weren't going to work have already not worked. So what we're left with is just the good businesses. And of those good businesses over the last 3 or 4 years, the manager, actually slightly longer, probably 5 or 6 years, the manager has demonstrated they are exceedingly competent at driving returns. They had a business called Solar Edge, for example, which has been absolutely stunning in terms of returns. So the two businesses they're left with, I think are cash positive and properly funded, and there's no issues with them. I would have expected an exit from one of them. If you wanted to clock back 18 months, I probably said there would be an exit last year, but I don't think the markets, and these would be public market exits, and the market conditions were just not right to do that. So those didn't happen. So those investments are still held.
You may like that, and the managers of those companies, or the lead investor, someone we've known and worked with for 30 years.
So to say, there's two big investments. I think it depends really when we think that public markets are going to come back. But the manager has shown, in relation to these remaining investments, they've shown the ability to exit things at attractive values. There's another big position there is Brockton, which is central London, ultra high-end real estate development. That property is now finished, complete. They have already sold a number of the apartments. It was actually finally a practical completion was relatively recently, and that the sales effort on the remaining apartments is now going to ramp up. They were impacted by COVID and so on and so forth. Couldn't take people around the site. I mean, these are apartments, just to give you a sense of it, which trade at £6,000 a foot or thereabouts. I mean, this is ultra high end, right in the centre of Mayfair. But with a clear run on the sales process now, we think that during 24 and 25, there's a stack of debt in the structure that's ahead of us. There's some senior lending that needs to be repaid first. But once that's done, depending exactly on the speed of sale, obviously, we should start to see some cash coming back from that.
What about Midhost?
Midhost is this is a co-investment. We hold around about 8% of Midhost, just over. This is a company which has been invested in for a long period of time, managed by a fund called Primus in the US. And interestingly, actually, the business I'll talk to you about, we don't control the exit there, but it's actually a very good example of what I was saying earlier about engaging in a dialogue with managers. We're actually in an active discussion with them at the moment about how we monetize, how we either grow or monetize that asset.
That's really interrupting, but it's worth noting. I think we made that investment in about 2004. We've had our money out. The company's been re-geared. It was doing about 3 million of EBITDA when we first made the investment, and today there's about 40 million. So it's no longer a development. It's a stable, strong company. We're getting out. We have the minority stake in that.
Does that portfolio generate any, I'm not sure if it'd be called dividends, but any sort of distribution cash?
Not on a regular basis. We did actually have a small distribution from Meadows last year because there was some preference shares which had been invested in about 2018, and those were repaid.
Very good
But
point.
it's not really a yielding portfolio. It will be, the cash flow will come back from exit of those underlying assets.
Our business that is generating real cash at the moment is the energy business, basically, and that will build on. And hopefully, when we get going on the retirement home business, which we've been working on for the last 2 years, that too will generate some cash from the co-investors.
So, I mean, the underlying portfolios of companies are generating cash, but it's not cash flow.
Okay, thank you. I do have a couple of other questions, but I don't want to.
Go on, please. Yeah, biscuits and coffee for anyone.
The second question, which is fairly straightforward, and I'm sure some shareholders will have this on their mind. The NAV in the last 12 months slipped a little bit, less than 10%, but the share price is down 40 or so percent, and the discount to NAV is now over 50%. So clearly that's not very satisfactory, and I suppose I wonder what the board's thoughts are in terms of how you might go about trying to reduce the discrepancy.
There is no magic wand to reduce discounts. The real way of doing it is showing performance, and then it takes enough time. And we don't want to do one-off performances. We're trying to build a business based on two solid foundations, one in the energy business and one in the real estate business. And frankly, all the other holdings are potential pools of liquidity. So that's where we're going. We have established the energy, and the real estate, we hope, will be obvious in the next period. Once that's done, and the bits of news go out into the market, the market tends to narrow discounts, and sometimes if they think you've got a really good business, put a premium on it.
Yes, I think I mean, all of that is quite reasonable, but I do think there is a timing issue for you in that from what's been discussed in terms of it takes a while to invest and there's not much cash coming out of mature for 12, 18 months. And Dacian is building, but it's a slow but steady process. If we're looking at the next 12 or 18 months, certainly the next 12 months, it doesn't sound like there's too much on the news flow front that's likely to change things. It's not to say that you might have something that happens, like an opportunistic exit that comes about. And I suppose it throws up a little bit the question of when you're looking at new investments, are there any sort of big picture criteria that you could indicate in terms of how you're looking at them in terms of, I don't know, returns, or it doesn't need to be too specific. I'm just trying to get a bit of a feel for
Target
mindset.
returns.
Yeah, well, I think, I mean, our target returns overall are 12 to 15% of what's there. So depending slightly on the investment, but clearly you're going to need to exceed that, at least meet or exceed that on the individual underlying investments you make. So that's very much in our mind. As I say, you know, we always want to know, and we look at Dacian, for example, we always want to know that initial investment and the assets we're investing in, how we have a sensible expectation of acceptable return on it. And on something like Dacian, it's well above 15%. But then we kind of overlay that with saying, well, really for LMS, you know, we're a small business and we need to punch above our weight to really move the needle for shareholders in terms of returns. So we are looking for these situations where that initial investment has got the potential to expand into something much bigger, which we participate in, using other people's capital. So again, we talk about data as an example. We would like to do some more investments in that sector with the management team we've got, but not necessarily putting our own money into those, but using the expertise and know-how that we've brought together in doing Dacian 1 can hopefully be applied to Dacian 2 and Dacian 3 and so on, and the LMS may or may not invest in Dacian 2 and Dacian 3, but even if it doesn't, we'll still share in the operating return that we're able to generate from those assets for the investors.
Okay.
I don't know if that answers your question, Blake.
Well, it certainly is useful to hear it enunciated because I've read the various things, but I get a feel for it. I mean, that those are quite sensible targets. So, but the thing I would put to you on the here and now is you've got your shares selling at 23p or thereabouts. You pretty much guaranteed, in fact, I think it's a risk-free, more than 15% return buying back your shares. Now, you're getting authority, hopefully today, to buy 10% back, which is less than £2 million. You're sitting on £17.5 million worth of cash. So it's not going to impede materially your ability to invest. I think in terms of signalling confidence in your strategy and sending a signal to the market overall, I think I'd commend looking at actually putting some buybacks into place as being something you can do. They're not a solve all because you still have to deliver your strategy, but it is a part of the jigsaw which many companies find very useful. As I say, if you don't deliver on strategy and performance, it's not going to do much for you. But if you're confident on that, it's quite a natural way of doing things. And of course, it's very good for the shareholders in terms of their NAV per share is going up. So they don't have to accept the thing, they see the value grow.
Yeah.
The short-term effect is undoubtedly there. If you buy back your shares, you get usually a blip. Looking at companies that have done this consistently over a long period, you lose that benefit. Market irons it out, tends to disappear. In our case, we're so small, and we've got to be so pointed with what we do with our cash. It would make our chances of success less. The less cash we have, the less chance of succeeding. And I think we've got to perform. I think we've got to show the returns are there. And if we, and the board is truly independent, if the board doesn't believe it can do it, the right way to do it is give you back your capital. In my opinion, we'll pay our dividends in the meantime, which we're doing. And if we don't succeed, then we shouldn't be buying in shares, we should be returning. Look out.
I think I take some issue with that, only because I don't disagree with the fact that many companies jump on the bandwagon, buy back shares as the sell for everything. But if their discount is being established because of poor performance, and the discount and the performance continues, then the discount will revert. You'll have a problem. But in your case, where you're looking at a performance that you're expecting to come through, I think it sends a very good signal, but it also is quite logical, because you've got cash that's going to be replenished from the mature portfolio in 12, 18 months' time. So anything you spend on buybacks, you'll get your money back soon enough. In the meantime, you've got a guaranteed value increase, which is a great message for shareholders, and it's actually in the best interest of shareholders as a whole. So I'm not promoting it as a willy-nilly. You know how a lot of investment companies adopt this compulsory, whenever the discount gets over, we will buy back. I think that's nonsense. But notwithstanding what you say,
I don't think it's black and white in any shape. I think you're right. We've got some mature assets that should be coming through, and it may be the right thing to do to an extent. The moment we can see quite clearly how we want to deploy our liquidity. If we prove unable to do that, then I think the solutions it'll be one of the solutions, but we're not there yet. 17 million, 18 million of cash is very useful in a market where borrowing things is very hard. And we believe we can leverage our returns by being core investors in the fields that we're doing. So I do hear what you're saying, but as long as we are achieving the building of the businesses we're trying to achieve, I think it's something we'll think very hard about before we buy back shares.
Okay, well, thanks for that. I think I suppose the proof of the pudding is in the eating. So
Very good.
If in the next 6 to 9 months we manage to deploy the capital with something that the market likes, well, then obviously that's fine. But if the going is slower than you'd like, I'd hope you'd come back to this and look at that as a, in the meantime, alternative.
I should stress we look at these all the time. We're very conscious. And the board itself has a significant holding in the company, so we are very conscious of it.
Thank you.
Thank you for the question. Yes, sir.
Well, as a follow-on from that, if I may, Robbie, as a long-term investor, long-term shareholder, a large discount doesn't worry me at all. In fact, I don't want the cash in our company to be used buying back shares. I want it to be buying investments for the long term. I think if you do share buybacks, that helps the short-term investor, not necessarily the long-term investor. I have no problem.
Thank you. I mean, we're of a like mind. If we start failing in the long-term investment, then believe me, we will not avoid that alternative. Thank you, Mark. Are there any more questions? Does the board have anything to?
No, I did promise. Well, I have had a question from a shareholder but I don't think it's been covered here, and I did promise we would deal with that question. And it's really about how we think about our costs, which at the moment are high in relation to our net assets. That was the thrust of this question. And all that, what I would say on that is I would say we are very aware of our costs, and we also we do acknowledge that they're high in relation to certain metrics. We control them very carefully. They've actually remained broadly flat for 3 years, and indeed last year they went down a little bit. But I think if you start to look at them as percentage, they are high compared to some metrics. I think that is a function, sort of just have the conversation really of our size. And the thing that is going to change that, and the way we think about changing that, is by creating these platforms, which will generate annual fees for things we do, my time, Robbie's time, whatever, with these companies, that can be validly seen as an offset and start to reduce our net costs. So effectively what we're doing is our overhead is being paid not just for managing our own capital, but for other capital as well. So again, I'm going to use data as an example because we've done it. We receive $200,000 a year annual fee for Dacian, and that's way more than we would normally receive for the fact that Robbie and I are on the board, and that is a reflection of the fact of LMS's role in creating the funding and bringing together that $14 million funding package, of which we were about 9, but there's other people's money in there for 4 or 5. And I think on subsequent deals we do, if we have that same dynamic with more capital, maybe much more capital than our own on some of the things that we sometimes look at, I think the opportunity for having a perfectly fair and reasonable fee that will help offset those overhead, those running costs is very valid, and that's the way we think about it at the moment. Until we're much bigger, that's the way we think about bringing that ratio down to something that people would hopefully be comfortable with.
Can I move on?
Can I just ask one point? Life's about people, Robbie.
Yeah.
And I read in the report that Doug Mills, who I didn't know, sadly died. Could you just mention a bit more about him?
I would like to. Doug I've known for a very long time. He was a financial controller at Weatherford and joined us about 20 years ago. Very closely supervised by Bernard Giordano, who's lead director at Dacian. Doug decided to come over here and work for us and to look after a number of our holdings. And he was a young man, he's 47 years old, and very sadly, he was very happy in England. Sadly died of heart problems. And I'm grateful you asked that question. We owe him a vote of thanks. He was an extraordinarily nice man. Then I'll move on to the resolutions which comprise the formal business of the meeting. Notice the annual general meeting, together with the explanatory notes, was published and posted to shareholders on the 20th of April. Accordingly, the requisite notice of the meeting has been given. I propose, therefore, that the notice of the meeting be taken as read. The voting procedures, to more accurately reflect the views of shareholders of the company, some votes for this AGM have been received electronically. There will also be voting by way of a poll, on which each shareholder has 1 vote for each share held. The final results of the voting, including the proxy votes on each of the resolutions, will be announced through our regulatory information services and published on our website as soon as is reasonably practical. We can give an indication of what we've seen. We will now proceed with the voting results on the resolution, which I'll formally propose to the meeting. Full text of each of the resolutions is set out in the notice of the meeting, a copy of which you have received. Resolutions 1 to 13 are proposed as ordinary resolutions and require a simple majority to be passed. Resolutions 14 to 16 are proposed as special resolutions, requiring a majority of 75% to vote in favour of the resolution. On the basis of the proxy votes, the resolutions are all passed, and they are displayed on the slide, on the side on the screen. So Resolution 1 deals with the annual report and accounts of the year, ended December 31st, 2022. And I propose that the annual report and accounts of the year ended 31st December 2022 be received. I declare that resolution carried. Resolution to approve the annual report on the accounts, report on directors' remuneration, which is Resolution 2, deals with the approval of the remuneration report. Other than the part containing the remuneration policy, the report can be found on pages 42 to 56 of the annual report and accounts, and there are copies here if anyone would like. I propose that resolution, the remuneration report, be approved. And I declare that resolution carried. Resolution to approve the group's future directors' remuneration, which is Resolution 3, deal with the approval of the directors' remuneration policy. The company is required pursuant to the Act to put the directors' remuneration policy to the shareholders for approval at the AGM this year. Having been 3 years since the company's current directors' remuneration policy was approved by shareholders at the 2020 AGM, the proposed future directors' remuneration policy is outlined in the directors' remuneration report enclosed in the annual report on pages 46 to 54. The proposed policy has been developed with advice from independent remuneration consultants and following consultation with the company's principal shareholders. This policy has been updated in light of the current best practice, with the proposed changes designed to provide further alignment of directors' remuneration with the long-term future of the company and the interests of shareholders. A summary of the changes proposed can be found on pages 46 to 54 in the annual report. I propose that the remuneration policy be approved, and I declare that policy carried. Next one is resolution to approve the company's employee share incentive scheme. Resolution 4 deals with the approval of the employee share incentive plan. Approval is sought for the adoption of the share plan as proposed in the remuneration policy in Resolution 3. The share plan will operate alongside the company's existing value creation plan. Yes.
I don't want to interrupt you, but I did have a question.
Okay, can I come to the end? It's hard enough doing the. Please do it at the end, which is described on pages 48 to 52 of the annual report, and is a vehicle to provide incentives to all employees, including senior executives of the company. The vote on this resolution is binding, and if passed, this policy will apply immediately following the AGM and will replace the current director's remuneration policy. This policy will be effective for 3 years without the need for a shareholder approval, unless any amendments are proposed to it. The directors will only be able to make remuneration payments in accordance with the approved new policy or an amendment to the policy. If Resolution 3 is not passed, the current director's remuneration policy approved at the AGM in 2020 will continue in effect until a new policy is approved by the shareholders. I propose that the employees' share incentive plan be approved. the vote. I declare the resolution carried. I will, however, of course, listen to your comment.
Well, I'm not sure how this actually works in practice, but one thing which does jump out when you read this, and bearing in mind the comments that I made earlier, if you're talking about a threshold for vesting of 15% total share remuneration, and I'm not for total share return, and I haven't looked at the defined print, but to state the obvious, with your shares so depressed, even getting back to where you were last year, I think you probably met the threshold without really doing anything as a business, because the share market had taken care of it. So I'm a little concerned that that vesting condition might not necessarily be the best one. If that's, apologise if my understanding of how it works is not correct.
I hear your point, and of course, when things are depressed, it always looks as if it's an easier thing to say. Can I pass that to the chairman of the remuneration committee?
There's, we are conscious of that. Obviously, we're resetting the long-term incentive arrangements. They have had two limbs, you'll have seen from the report. But we can only start from current share price, but to ameliorate that problem you just identified, there is an 8% hurdle, 8% compound per year as a threshold before participants in the scheme will receive anything. So we don't start from zero. We start from that 8%, and then as you will have seen from the document, the returns of the participants tracks certain percentages in terms of total shareholder return.
Do you
in that period
look to stagger the issue? So in other words, do you do some this year, next year, and the year after? Because if you stagger the issues, what you tend to get is an averaging, which to a degree takes care of the problem, because hopefully next year the share price is a lot higher. So where it becomes more of an issue is if you do a big lump and it's right at the bottom of the market.
Yes and no is the answer to that. The long-term incentive plan falls into there are two limbs to it. We're retaining the value creation plan, which tracks total shareholder return, so in terms of capital increase and dividends distributions paid. So that's part of it. And in that sense, we do start from an average of the share price over the last 6 months, assuming that the plan will be approved. And we take that as the starting point, but there's a 5-year look forward on that, and we look at the total shareholder return over that 5-year period. The other elements which we were introducing is the share plan. What that allows us to do is have more flexibility in terms of issuing annual awards that have a 3-year look forward period of a minimum of 3 years. And so we can set performance conditions against those awards looking forward 3 years. And that will continue even beyond the 5-year period as well. So we've got a mixture of things there. So it will, that part of it will have the effect you just identified.
Thank you.
I carry on with the meeting to approve the final dividend. Next point is resolution number 5 deals with the declaration of the final dividend of 0.625 pence per ordinary share for the year ending 31st December 2022. In view of the results to the year 2022, the directors are pleased to recommend a final dividend of 0.625 per ordinary share. I should now like to propose that a final dividend of 0.625 pence per share be declared and payable to the registered members as of the close of business on the 27th of May 2023 in respect to the shares then registered in their names. I declare that resolution carried. The next resolution deals with my re-election, and I therefore stand back to let the chair to Nick.
Thank you, Robbie. I'll give your voice a rest. It's been quite a lot to read. In accordance with the recommendations of the UK Corporate Governance Code and the Articles of Association, being eligible, Robert Rain offers himself for re-election at this annual general meeting. The board is recommending that Robert Rain be re-elected as a director. We have the results of the voting up there. On that basis, I declare the resolution carried.
Thank you, Nick. The resolution to elect directors, resolution 7 to 10, relate to the election of Nick Friedlos, Peter Harvey, Graham Stedman, and Jamie, who is behind the numbers, who have been appointed by the board since the last annual general meeting. It is a recommendation of the UK Corporate Governance Code and a requirement of the company's Articles of Association that all directors should be subject to election at the first annual general meeting following their appointment. Accordingly, Nick Friedlos, Peter Harvey, Graham Stedman, and James Wilson retire at this annual general meeting, but being eligible, offer themselves for re-election. The board is recommending that, as Resolution 7, Nick Friedlos be elected director, and I'm happy to declare that resolution carried. That Peter Harvey be elected as a director, and I'm delighted that that resolution is carried. And that Graham Stedman be elected as a director, I declare that resolution carried. And that James Wilson be elected a director, and I'm happy that that too has been carried. Resolution to reappoint auditors, resolutions 11 and 12, deal with the reappointment of BDO LLP as auditors and authorize the directors to set the auditor's remuneration. I propose that BDO LLP be reappointed as auditor to the company to hold office until the conclusion of the next general meeting at which accounts are laid before the members. I declare the resolution carried, and I propose that the directors be authorized to determine the auditor's remuneration. Resolution to authorize the allotment of shares and disapply the preemption rights, resolutions 13 and 14, deal with the allotment of new shares and the disapplication of preemption rights as explained in the notice. I propose that resolution 13 in the notice of the meeting be passed as an ordinary resolution, and I declare the resolution carried. And I propose that resolution 14 in the notice of the meeting be passed as a special resolution, and I declare that resolution carried. Resolution to authorize the company to purchase its own shares, resolution number 15 gives the company authority to buy back its own shares subject to certain limits as explained in the notice. And I propose that resolution 15 in the notice of the meeting be passed as a special resolution. And I'm happy to say that resolution is carried. Resolution to convene meetings on 14 days' notice, which is resolution 16, gives the company authority to call a general meeting other than an annual general meeting on 14 days' clear notice. I propose that resolution 16 in the notice of the meeting be passed as a special resolution, and I declare that resolution carried. We're nearly there. The concluding remarks are that that concludes the business of the meeting. I'm very grateful for you coming. It's heartening to see faces and to have people here. The final results of the meeting will be announced to the markets through our regulatory information service and posted on our website as soon as practical. We wish to reiterate that should anyone have any questions, please kindly send them to the email address on page 2 of the AGM notice, and we shall respond where possible directly. Questions received during the webinar session will be answered after the meeting, which is now. We look forward to speaking with as many of you as possible informally over the coming months and seeing you in person at the next AGM. that concludes the business of the day. And I thank you. Thank you all for coming.
Thank you.
Thank you to the board for updating attendees today. Could I please ask attendees not to close the session, as you'll now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the board of LMS Capital PLC, we'd like to thank you for attending today's annual general meeting, and good afternoon to you all.